Today we're looking at the utilities company National Grid. It is trading towards its 52-week low. This is a company with a yield of nearly 6% and a lot of upside, as we're about to understand in today's episode. We can see a buy rating from Wall Street, but quite contradictory with the other two. We have a sell from Seeking Alpha and a hold from Quant. As always, we are going to do a deep dive into this company, and one of the things we will touch upon is that dividend safety score that we can see at a borderline safe level. We'll also take a look at the institutions who continue to be buying shares of this company within their own portfolio, and we'll look at the deep dive of the numbers, their top line revenue growth as well as their bottom line net income, whilst also looking at the health of the company, which is very important for a company that does pay a high yield with a borderline safe score, total cash versus total debt, as we always do on the channel, and ultimately we will run it through the valuation model, where we do see some very nice upside, getting to the intrinsic value given our acceptable buy price, as well as looking at our investor margin of safety, and also look towards Wall Street to see what they're forecasting for the next 12 months. So let's jump straight into this utilities company, and what we can see on a forward P, this company is trading around 13.3. Just for perspective, S&P around 22 at the moment. Over the last year, it is down around 11%. If you've been a long-term shareholder, now you would be down around 21%. Bear in mind, if you were to reinvest dividends, it would be slightly higher, but we can see this company goes through a lot of ups as well as a lot of downs. The more recent all-time highs that we can see around $80 April 2022, quite some way away of what it is trading now, around the $58 to $59 mark. In terms of the top line revenue, now one thing to bear in mind is whilst we do want to see 3 to 7% in terms of baseline growth, utility sector is very cyclical. We will see peaks and troughs, and as we can see on a graphical basis, whilst essentially the top lines has been increasing over the longer term, over year on year we can see increases followed by decreases. Ultimately though, they have increased their top line 19.8 billion in March 2015 to around 25 billion in the latest annual report, which is actually March 2024, so not even that long ago. When we then take a look at their bottom line net income, what we can see is around 3 billion reported in 2015, and in fact pretty much the same reported in 2024, just reinforcing that cyclicality with this industry and with National Grid. And we can see as well graphically in terms of the movement year on year, lots of changes, increases followed by decreases across the board. Something that you just need to understand with cyclical companies like National Grid in the utilities sector. We then take a look at the health of this company, their total cash versus total debt. Now, what's nice to note, their cash position has increased 177 million in 2015, 705 million in their latest quarterly report. So it has increased, although again, we can see inconsistencies even on their cash balance year on year, as well as over the longer term. And like we said, that number doesn't really mean anything until we take a look in perspective, numerically and directionally, with their total debt, 42 billion in 2015, 61 billion in their latest quarterly report. So whilst their cash has increased, their total debt, which was already starting off at a very high position, has also increased, and this already shows us that we will need to consider that dividend safety later on in the episode. Over the longer term though, total debt has been increasing, but again, with utilities as a whole, this is a common trend that we do notice. Now, we want to point out very quickly, in terms of their earnings per share estimates over the next few years, as well as the revenue, they're anticipating 450 in 2025, the next full year, 494 in 2026, and we can see that would give them a forward P of around 12.11, and this just reinforces that cyclicality. As we can see, the next full year they're anticipating 27.28 billion to the top line, March 26 around 26.89, so we can see year on year small increases followed by small decreases. Just something to bear in mind. Doesn't necessarily mean it isn't a company that you can invest in. After all, this is one that we do see a lot of upside in, as we're about to find out. In terms of the valuation grade, well, they get an A-, so off to a good start. P, as we mentioned, 13.3. In terms of others in this utility sector, 16.35. So as we can see, you are getting a discount of nearly 20%. In terms of other metrics as well, you can see very favorable grades, B+, A and A-, And if you were to look at it on a price to book trailing 12 months, 1.15, again a discount of 32%. On a price to sales forward looking as well, you can see pretty much across the board it is trading significantly lower than that of the sector medium. Now when we take a look at essentially the growth grade, now this is where things do start to get a little bit poor. They have an F grade. Reason for this? Well, the industry as a whole has been negative, but for NGG, negative 8%, the sector around negative 4%. Forward looking, pretty much flat on their top line. As we can see, the sector, whilst they are anticipating growth, even very low 2.83%, it is still better than what we can see for National Grid. Now, there are the metrics here that if you do want to take a look, you can incorporate into your own investment thesis. The other thing that we would point out, earnings per share on a forward basis, 2.44 year-on-year increase for the next 5 years. As we can see, the industry as a whole, 6.37. We then move on essentially to the profitability, and they do get an A+. Now what we can see, gross profit margin 100%. We see the sector a lot lower at 44.62. Bottom line on a trailing 12-month basis, 11.54. Not that far dissimilar, in fact, from the sector of 12.38. And when we take a look at their cash from operations, significantly higher, 8.8 billion versus 1.3, hence why they get the A+ rating. Now, a quick conclusion to this part of the analysis gives us a sell rating from Seeking Alpha, a buy from Wall Street, quite a high, that is 4 out of 5, and a hold from Quant, so very mixed across the board. A- on valuation, an F on the growth, and an A+ on profitability. Now, the next thing that we want to draw your attention to is how they performed over the longer term. What we can see in the utility sector, we have quite a few popular names. In fact, we have reviewed Dominion Energy not too long ago, as well as a few others. So over the last year, now this incorporates reinvesting those dividends. Total return, you would be down negative 9% with National Grid. When we expand this over the last 5 years, you would actually be up around 49%. You'd be in the top 3 of their competitors. And if you expanded it over the last 10 years, well, you can see you would be towards the bottom, down, or in fact up 22.54%, but in comparison to others like PEG up 179%, it hasn't been the greatest investment over the longer term. But as always, the past performance of National Grid has nothing to do with their future performance. They could perform significantly better. In fact, they could perform significantly worse as well. Now, before we do jump into the dividend safety score, just to let you know, we've released our latest free weekly article running through 12 undervalued dividend stocks. We talk about high quality companies. If you want access to this completely free, do click on that pinned comment below. You can also read other articles here, for example, how to find undervalued stocks, all the websites and resources we use on the channel, as well as other articles, all completely free. Now, we also want to draw your attention to institutional ownership. We can see that around 5%, 205 million worth of sales by the institutions over the last 12 months. During the same time period, though, we see nearly twice the amount of buys by these institutions, and in fact, we see significantly more buying in Q1 of 2024, the latest period, as well as the previous period as well. So lots of institutions who are buying a lot more, as this company, as we saw, has been decreasing over the last year. But as always, do your own due diligence. Don't just copy what these institutions do. In terms of dividend safety score, well, 45, it does look to be borderline safe. This is a company with around 43 billion market cap, a large cap company in fact. And when we take a look, it was reaffirmed at the end of last year, that borderline safe score, effectively meaning that there is a moderate risk of a dividend cut over a full economic cycle. Now, how did they perform during the last recession? Well, they increased the dividend during the 07-09 crash. They had negative 11%, pretty much around the average of the S&P, but they did marginally outperform, negative 49% recession return, S&P negative 55. Now, for a company that has a forward yield of over 6%, in fact, their last full increase, 6%, very positive, above the 4% minimum inflationary target. Over the last 5 as well as the last 20 years, you're at least getting an inflationary increase with this company, which is great to know, especially for that nice yield. Though we do see 6 years of consecutive increases, as well as 6 years of paying a dividend without a reduction. Now, in terms of looking at dividend yield theory, as always, for those that are new to the channel, it states the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation. Do bear in mind, though, we're not looking at any of these models in isolation. Another undervaluation signal with the forward P 13.3 below the 5-year rolling average, and we can see significantly lower than these utility sector at 16.2. Now, on this channel, we do draw your attention essentially to the free cash flow payout. However, for utilities, a lot lot more volatile, so we do bring your attention back to the earnings. Below 75% is the preference for utilities. Now, over the longer term, they in fact went through a period where it was significantly higher. Nice to note, 2024 at 70%, so a lot lower than the previous year. Also in 2025, it is anticipated to go up to around 82%, which isn't the worst, and that does hopefully mean they can continue at a bare minimum to increase those dividends right in line with that 4% inflation rate. We then move on to the earnings per share. Now, we do want consistent increases over the longer term. Just understand that you are investing or looking to invest in a utilities company, so cyclicality is the name of the game here. Hence why we see a very nice 84 cents from the previous year, 64, but also into next year they are anticipating a drop down to 71 cents per share. In terms of both earnings per growth, as we can see on here, and on the sales growth, lots of volatility, lots of cyclicality year on year. As we mentioned, we do like to see steady moderate growth of 3 to 7%. In fact, just 5 of the last 10 years we see negative growth. And if you do look at it over the longer term, like we did earlier on, you still do see growth over the longer period. One thing that we always like is when companies do share buybacks, returning excess cash, so decreasing share count. We actually see the opposite. However, this is something very typical that we do note with utilities as a whole. Just bear in mind that they do rely on this so that they can fund a portion of their expenditures. Therefore, your position as a shareholder would be dilution over the last 10-year period if you have been a shareholder or investor during that time. ROIC then, return on invested capital, very important. 10% or more for majority of companies, 7 to 8% for utilities if you want to be industry specific. Just to give us faith, management are able to effectively allocate their capital. And what we can see here on the graph is, in fact, it has been straddling around that 7% over the longer term. Hopefully, on a trailing 12-month basis, it does at a minimum stay at that 7% level. We then take a look at the margins, above 18% for utilities. It has pretty much been above that, although inconsistently over the longer term. Last year was very strong at 28%. And as always, what we want to identify are companies that increase both their top line as well as their margin. Although you could argue from 2015 to 22%, they have increased it to around 28% in 2024. Now, the net debt to EBITDA, remember the earnings before interest, tax, depreciation, amortization, correlating to balance sheet strength, dividend safety, below 5.5 for utilities, and as we can see, it has straddled around that for majority of the last 10 years. And just a reminder, these are the number of years it would take the company to pay off all of that debt net of cash on hand. 5.81 in 2024, pretty much around the same over the next full year, so it isn't that much higher than the maximum we want to see. Also, the payout isn't that much higher, so yes, we do understand it is borderline safe, but unless something drastically changes, for now that dividend does look to be safe. In terms of the valuation, let's jump in. As always though, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. First model we're jumping into is the multiples valuation model. We have companies in a similar sector and size. Their PE multiple, the average, multiplied by that of NGG to give us an intrinsic value here showing undervaluation. Just bear in mind that we're not looking at any one of these models in isolation. We then move on to the dividend discount model. Now they do pay this in GBP sterling, so we have just gotten the latest yearly dividend. And as we can see, 4% was what they have increased it over the last 5 and 20 years. So we've gone a bit more conservative at 3.5%. And as we can see here, another undervaluation signal. Now typically the discount and cash flow model would be the third model we would use. However, as we said for utilities, a lot more volatile, so it isn't that accurate. So we jump straight into the intrinsic value, and in today's episode, it is the average of these two models, which aren't too dissimilar from each other, around $86.51. Now do bear in mind, you can grab a copy of this model to get your own intrinsic value, your own acceptable buy price by clicking on the pinned comment below, whether you want to run the numbers through this company again or others in the market. So margin of safety then, we always start off with 10% and we execute on that if we believe it meets our 3 criteria. A wide moat, strong financial metrics, good forward-looking data. If you believe that, well, it would be about up to $78, and then we keep going till it's near the current trading price. And in today's episode, we can see quite a sufficient margin of safety. Not quite there at 35%, so it does at a minimum up to $60-$61 hold a 30% MOS level for a company that has historically had a nice forward yield around 6% or more, as well as a nice increase over the long term. At a minimum, it is in line with inflation. In terms of Wall Street and their forecast, well, over the next 12 months, they do anticipate $72 as their price target. They see upside of 24% As we saw, they do indicate to be this a fairly good buy, 4 out of 5 in terms of the analyst score as well. As always though, do let us know your thoughts in the comments below, whether or not National Grid is one that's on your watch list. Maybe you are buying shares of this as it has been dropping over the more recent period, or in fact maybe this isn't one that you are interested. Let us know the reasonings why. And as always, if you enjoyed the content, smash that like button, hit that subscribe and bell button. We'll see you all on the next one.